Stocks see a sharp sell-off across the board as concerns over valuations kick in. Autos and metals are the biggest losers.
SUV major M&M skids after it cuts prices of its XUV 700. Tata Motors too trims tabs for Safari and Harrier, even as Maruti and others offer discounts. Analysts see this as a sign of slowing demand and increased competition.
Ashu Singhal, the MD of Mahanagar Gas, tells CNBC-TV18 he's heard of a likely cut in excise duty on gas, even as the industry bats for bringing gas under GST. He points to a sharp reduction in Indian gas allocation as a pressure point.
Emcure Pharma lists at a hefty premium of over 30% to its offer price of 1,008 rupees per share, while Bansal Wire too lists at a near 38% premium to its offer price of rupees 256 per share. Both offers very heavily oversubscribed. Good afternoon, you're watching us here on Halftime Report. I'm Manglam Malu, with me Ekta Batra. If you've just tuned into the markets, you would see there's a near 160-point decline on the Nifty, 400 points off the Nifty bank. So there is a fair amount of weakness across the board. But over the last couple of hours, while there has been a decline from the highs, there has also been a strong recovery from the lows, bringing Nifty back into its range of 24,150 to around 24,500 itself. So as you can see, we opened up at a record high. From there itself, there was a big cash that we saw, a lot of profit taking, and then thereafter, there has been some semblance of recovery from the lows itself. The broader markets still under pressure, 1,800 stocks in the red for about 500 in the green. Hi, Ekta.
Hi, Manglam. Yes, absolutely. You know, the Bank Nifty, for example, has recovered around 80-odd points from the day's low. The Bank Nifty low was around 52,077.9. And otherwise, we have the Midcap Index, which has recovered a cool 800 points from the day's low, along with the Nifty, which is off around 122 points from the day's low as well. So there has been a recovery. Let's see if it can get bought into further and whether there is any kind of further upside that we can see for the markets. Remember that there's a lot of cues which are lined up in the next couple of days. We have Jerome Powell, the Fed chair, who will be giving a testimony to Congress today as well. And then we have the US CPI data to reckon with. So there will be a lot of cues from the global front as well as from the Indian front, because we have earnings such as TCS as well as the CPI data, which the markets will be reacting to. But nonetheless, as of now, let's see whether there's further amount of recovery. Currently, the Nifty is still down around 161 odd points. But we have a lot of stocks to cover. Let's start with one of the big stocks in focus today. MGL is in focus today as the company has hiked CNG prices by 1.5 rupees per kg for CNG and 1 rupee per SCM for PNG. In our Insight Edge segment on Halftime Report, Sonal is here with more details on this story. Sonal.
Thank you so much for that. Well, a number of things that have happened for the CNG industry. First up, of course, Mahanagar Gas has gone ahead and increased prices both for the CNG and the PNG segment, to which the management said it is for a number of reasons. First, the domestic gas allocation, the APM allocation, which happens to priority sector like CGD, it has reduced substantially in last 1 year. It has come down to 68% versus 82% earlier. Remember, during COVID, it was as high as 120% as well. So that sharp cut means that they will not be getting cheaper gas, because of which they have to go ahead and buy imported gas, and that is coming in at costlier prices. Right now, the spot LNG prices are around $12 per MMBTU, and that's why their mix is getting very expensive in terms of raw material prices, and that's the reason they've gone ahead and increased prices. The second event is Bajaj Auto launching CNG bike, which was supposed to be a big market for all these city gas distribution companies. However, Mahanagar Gas says that conversion of volumes from bikes will take a lot of time, because the capacity of a CNG bike is around 2 kgs in terms of the CNG that they require. So it will not convert to volumes immediately in this fiscal itself, but they could see some impact coming in from next year. However, it will still be very cheap versus a petrol bike, and they could see conversion going forward. In terms of budget expectations, because there have been reports suggesting that the government could go ahead and cut excise duty on CNG and also gas coming under GST. Of course, that is not something that will be discussed in the budget, but they did indicate that they are hearing something around it. There's no surety here, but if it does happen, it will be positive. They will be able to pass on the price cuts to customers as well. And if gas also comes under GST, there would be a pass-through. Input costs will be allowed and credit will be allowed, reducing costs, improving EBITDA for them. So that would be a win-win as well.
All right, take that point, Sonal. Thanks a lot for that. So the insight that Sonal gave us an edge over. Let's hear that insight itself. Ashu Singhal, who's the managing director at MGL, spoke to us this morning. Let's listen into the excerpts of that conversation.
We were getting APM gas, which is at $6.50. From 82%, it has come down to 68%. So there is substantial reduction in the APM gas, which is the domestically available cheap gas. And the LNG prices were earlier down, but now it has started increasing again. So we are constrained to increase 1.5 rupees in the CNG prices. However, still we are the cheapest in the country in terms of CNG prices and PNG prices. The per bike consumption, the cylinder capacity is only 2 kg. So to see any significant increase in our volumes, the number of bikes should be very huge. So it will take some time. Maybe next year we will get some volume, maybe 2-3%, and afterwards it can increase furthermore. But definitely it will take some time to, one, that people are getting used to the new bike, although it is definitely much more advantageous in terms of running cost. So double the numbers will give us maybe 10% volume, but then the numbers of bikes should be around 7-8 lakhs, which will take a substantial period to come to that number in Mumbai or in our geographical areas. The budget is passed and what is included in the budget or not. The other point which we are hearing is maybe the gas can be included in GST, because if that so happens, then excise duty cut will not be required. It will be one tax regime for the gas segment itself.
Okay, so that's MGL. That stock is in focus today, up around 2%. But the other stocks that we're tracking is Delta Corp, which is in focus after reporting a seasonally weak first quarter. So it's reacting to its first quarter numbers. The stock down around 4%. While KDDL is also on our radar, as the company has announced a tender route share buyback up to 88 crores. Mangalam, you're tracking both these stories. Tell us more.
Yes, it's a tale of two cities, right? Delta Corp down about 4%, while in an otherwise wobbly market, KDDL is up around 1.5%. So let's talk about Delta Corp itself. Seasonally, the first quarter is typically weak for casino companies. The third quarter is the strongest in the year. So it was once a seasonally weak quarter. Add to that, between Q1 FY24 and Q1 FY25, what changed? The GST regime changed. Apart from that, we had in the first quarter itself elections, and then there was a massive heat wave which impacted tourism in Goa itself, and that's something that Puneet Satwal said to us yesterday as well. So all of that has impacted their casino operations, whereas weakness in the online skill gaming business along with higher customer incentives led to their near entire revenue erosion in the online business as well. So to put all of these things together, the company actually saw a revenue erosion of nearly 30% year on year, and as a result of which the EBITDA fell by about 68%, margins compressed from about 37% all the way down to 17%, and the net profit also came down by about 68% as well, and that's something that the street, did not like. Remember, the stock has been an underperformer, so a large part of that would perhaps be in the price, but nevertheless, it is weak. Casino business saw a revenue decline of 25%, an EBIT decline of 60%. Online gaming, net of incentives, 23 crores turned into just about 2.5 crores, so near 90% erosion out there, and EBIT loss widened out there too, along with hospitality business, which saw a revenue erosion of 17%. On the flip side, Kamla Dials and Digitals Limited, or KDDL as we know it, has approved a buyback. The board has approved a buyback of 88 crore rupees. They would buy back about 2% of equity at a price of 3,700 rupees per share. This price is about 12% premium to the current price of the stock. Why is it that the stock is not moving that much higher? Because it's at the end of the day just about 2% equity. So the acceptance ratio would be 1 in 50 shares that you will give to the company. And the promoter stake is also 50%. They are included in this buyback. So for retail, the chance of your share getting accepted at 12% premium is lower. And the other thing that plays out for KDDL is the fact that it is also the promoter of Ethos, the watch retailer, and they have a stake of almost 3,100 crores in the company. The own market cap of KDDL is about 4,200 crores, so nearly 70-80% of their value is coming in from Ethos. If you add a holding company discount, so that keeps the downside on Kamla Dials Limited. So this basically provides a bit of a floor to the stock price and is doing well in an otherwise weak market.
Okay, all right. Thanks, Mangalam, for that. Well, on that note, we need to take a short break, but we'll be talking to Shanesh Shah, who's the president of the hospital company Shalby, to discuss their performance on the quarter gone by. Stay tuned. Welcome back. Well, for the Nifty, 24,267 is where we're at. A lot of stocks are under pressure, but they've recovered from the day's low. So, for example, a case in point would be Supriya Life, which at one point was down around 7% is now down around 4%. So, there has been some amount of recovery which has taken place from the day's low. A couple of other stocks which are under pressure include something like a Popular Vehicles. That stock is down around 3.7%. SAIL, GSFC, Phoenix Mills. All of these stocks are showing declines of anywhere between 3 to 4% at this point. But let's talk about the auto space. It was in focus yesterday on account of Maruti. But today we have the auto sector which is in focus as leading SUV maker Mahindra Group and Tata Motors have slashed their SUV prices, and that's reflecting on a couple of these stocks. Parikshit joins in with more details on this.
Well, yes, within hours of each other, two leading automakers, Tata Motors and Mahindra Group, slashed prices of some of their top-selling SUV models. Now, this has given the street a view that there is weakened demand in the market, and that's why the price cuts have taken place. For Mahindra, the price cut is specifically sharp because they brought down the cost of their top model of the flagship XUV 700 by about 2 lakhs. Tata Motors, on the other hand, has reduced prices of the Safari and Harrier in the range of 50 to 70,000, and they're also offering benefits in the range of 1,40,000 rupees. So there is obviously a question about weakened demand in the market. We have been seeing a high amount of inventory in the system. In fact, the Federation of Automobile Dealers has said that there is almost 62 to 67 days of high inventory in the system. There are 6.5 lakh unsold cars in the system, which have an average ticket size of 9 lakhs each, and the total inventory in the system would be worth around 60,000 crores at present. So there was an urgent need to correct the inventory. Now, they've attributed a number of reasons to the slow sales right now and the muted sentiment. One, because of elections, the offtake was slow. Then you had the heat wave and the customers were not really coming to the showrooms. Now you have high rains, you've got the sowing season, also the Shraddh in different parts of North India. So Q2, the sales are expected to be low and the demand is expected to be muted. This is what the Society of Indian Automobile Manufacturers has also forecast. What we are seeing that across the board, all automakers, including Maruti Suzuki, Renault, Hyundai, MG Motor, they are all giving high discounts at present because they want to generate demand for their products. But the price cuts that we've seen from Tata Safari, Tata Harrier and Mahindra XUV 700, this is significant. Tata is offering these low prices for about 1 month, Mahindra for about 4 months. Let's see if the companies would sustain with these prices going ahead or increase them once again. But clearly this is a story to watch out for, and there is high inventory in the system. And many dealers also saying that we are now not in a supply constraint situation anymore. It is a buyer's market at the moment.
Right. Just a word on... Thank you, Parikshit, for that. Speaking about the auto space itself, there's news coming in on Greaves Cotton as well, where their arm Greaves Fin has partnered with ACCO to facilitate seamless EV ownership across the country. And that's very interesting because, you know, Greaves Cotton has seen a big re-rating largely because of its EV foray. And it was only a couple of days ago where they announced the appointment of PB Sunil Kumar as CEO to actually accelerate EV financing. This is the CEO of the Greaves Finance business. So they are going into vehicle financing as well. And he's been around for a while. So, you know, Mr. PB Kumar, Sunil Kumar has been at multiple companies, including ICICI Bank. So they're getting finance heads, now tying up with an insurance company. So maybe that push towards EV is something that, you know, the street is looking at.
Okay, interesting. So getting into EV financing, that's Greaves Cotton for you. That stock at around 170 odd rupees. But let's talk about Shalby, the hospital company. It's in focus on the back of their Q1 numbers. Margins were weak. Occupancies also saw a bit of a dip. To discuss this and more, we have Shanay Shah, who's the president of Shalby, joining in now. Shanay, hi. Thanks very much for taking the time out. You know, I'm going to talk about your margins to start with. 16% is where they've come in at. That's been a bit of a disappointment to the street, and most of the analysts are of the opinion that your latest acquisition in, in Gurugram is actually probably one of the reasons why there is this pressure which is coming in on the margins, the Sanar acquisition. Can you give us a sense in terms of what the performance of Sanar was this quarter for you, and is that the reason for the pressure?
Hi, good morning, Ekta, and thank you for having me on your show. In fact, the growth has been quite significant. If you look at, the revenue growth for the quarter, we have grown at 20% on a year-on-year basis. And on the EBITDA front also, we have grown at about 15%. You're right, the PAT margins have been under pressure, and that is, a significant part of it is because of the Sanar acquisition. However, having said that, it was anticipated because the hospital is relatively new. It did a revenue of around 24 crores in this quarter. Although it was a bit neutral, the depreciation and the finance costs for that unit, kind of put some pressure on the profit before tax margins for this quarter.
So it's loss making. Did it make any money on the EBITDA line, and on the bottom line, what was it?
Yes, so the Sanar acquisition made EBITDA break even, and at the profit before tax level, those margins were under pressure because of the depreciation and the finance costs.
Got it. So when do you expect it to break even on the bottom line and be EPS contributive?
Right. So, this unit is a typically new unit, and, of course, it has done really well over the last 1.5 years since it has been operational. So, in fact, the current run rate at which it is going, we'll be looking at doing anywhere between 120 to 150 crores. So, in this financial year. And we know that it will be EBITDA positive for this year. However, I think in the next financial year, we will see it to be accretive to the EPS as well.
All right. And the other reason why your profit margins were also impacted was because of the higher effective tax rate. It went as high on a reported basis as over 50%. Can you explain this anomaly, and is this likely to continue in this year?
So if you look at the margins, I mean, if you look at the numbers, we stopped taking the deferred tax asset, for implant business in this year. So because of that, there has been an impact. But if you normalize that, then if you compare year on year, the PAT margins and the PAT number, the absolute number was actually flat.
Effective tax rate for this year, what should analysts typically factor in?
So if the implant business continues to kind of grow the way it is growing, we will see it anywhere between 33 and 40%. However, the effective tax rate is much lower because we are actually paying MAT, the minimum alternate tax, which is about 18%. We will be out of MAT after the first half of this financial year. In the latter half, we'll start paying we'll be in the normal tax regime, which is 22% plus the other surcharges.
Okay. Well, you mentioned implants, so I'm going to ask you about that, Shanay. The implant business still making an EBITDA loss. When do you expect it to break even on the EBITDA as well as on the profitability front?
So the EBITDA business the implant business has typically grown about 50 to 55% on a year-on-year basis for us. And, we expect this kind of growth to continue. The EBITDA has been largely flat. We have been EBITDA neutral. But again, because of the depreciation and the finance costs, we have seen it affecting the PBT margins. However, by end of the year, by end of this fiscal year, which is Q4 of this year, we believe that, we will be in a much better shape than where we are at the moment.
When you say much better shape, what do you mean by that?
So I'm saying basically we will be seeing that, we will be positive EBITDA margin anywhere between 8 to 10%. So that's what we are projecting for the end of the year.
And what is the revenue target for this year? I mean, is 130 to 150 crores possible for the implant business?
Yes, that is the target. About 130 to 140 crores is the target for this financial.
Okay, 130 to 140 crores with 8 to 10% sort of EBITDA margins as well. But apart from, the acquisition and the implant business, etc., what is your general target for this year when it comes to occupancy, the increase in number of beds that you have, and average revenue per occupied bed?
Well, the average revenue per occupied bed, has grown for us for two reasons. One is that the arthroplasty business as a proportion of the total business has grown. So, that is high ARPOB for us. And secondly, you know, with the Delhi acquisition, the Delhi ARPOBs are higher. So that has actually pushed our ARPOBs from the, you know, from what we were last year at 38,000 to about 43,500. And we expect it to continue at these levels. In fact, grow from here because the Delhi unit will continue to add a higher revenue as a proportion to the total hospital business. In terms of the inpatient count and the outpatient count, again, you know, if you look at the year-on-year numbers, we have grown about 15% on a year-on-year basis. So again, you know, we expect that kind of momentum to continue for us, you know, going forward.
So when you talk about the ARPOB, what is the kind of incremental increase that you're expecting, you know, Shanay? Because after a point, it's difficult to pass through those kind of ARPOBs to the customer or to the patient as well. So do you expect it to eventually plateau somewhere? And, you know, if you are expecting an incremental growth, how much is it? And where do you probably expect it to stabilize?
So, Ekta, I think, you know, if you look at, you know, I mean, if you look at our numbers without the Delhi acquisition, the ARPOB numbers have grown typically 5 to 6% on an annual basis. So that is usually what we are able to pass through to the customers. And that is what I think the market also kind of prices in, you know, when they are kind of making, you know, their analysis. So basically, that's what we see. But Delhi, again, because of the virtue of, you know, the market, you know, the ARPOBs are typically higher. And that has kind of typically increased our ARPOBs for this particular quarter.
So 5 to 6%, which would pretty much be in line with inflation itself. And final question, then this is on your balance sheet and capex plans. What's the current debt on your books? What's the reduction plan here? And as far as bed addition is concerned, how do you do that? Will that be via your internal capex or franchisees or acquisitions this year? What's on the cards?
Sure. So typically there are three things that we are working on right now. So we have a Rajkot hospital coming up. So that will start, and we've already done the soft launch. It will start in this particular quarter itself, which is Q2. We are also, you know, expecting the nod from the Charity Commissioner's office, you know, very soon for the Mumbai project. So, you know, again, we are looking at an investment, you know, in that particular asset of about 250 odd crores. The current net debt on the books, you know, is about 170 odd crores. So that's where we are, which is quite comfortable because we are looking to have an EBITDA of anywhere around 250 crores in this year. So which translates to about 0.7, 0.8 times, you know, debt to EBITDA. And lastly, of course, we are looking at, you know, how we can kind of expand the Delhi NCR facility because we have additional FSI there. So we are working on that with several consultants.
Okay. Well, before we let you go, Shanay, anything with regards to, you know, the fixed rate for hospitals, the centre's response, you know, the pleas probably made by the industry associations, where do things stand?
So very honestly, we haven't, I think the next hearing is expected to be in a couple of weeks. We haven't heard about anything coming from their end. However, we believe that, you know, we are going to be least impacted because, you know, as you can see, our ARPOB numbers, etc., they are much lower compared to the industry.
Okay, all right. Okay, Shanay, we'll touch base with you when we have to chat about that more in detail. Thanks very much for joining in and speaking with us. So that is Shalby. That stock has been under pressure post its numbers. That stock is down around 2.3% at this point in time. They are expecting around a 5 to 6% ARPOB or average revenue per occupied bed to continue for their hospitals and maybe a break even for their implant business this year. We'll take a short break. Pritesh Mehta of US Securities will join in with some of his trading calls. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Perfect time to bring you up to speed with all that's taking place in the markets at midday. there is a bit of a decline that we're seeing on the Nifty, down about 0.75%. The Nifty Bank down 0.8%. The Midcap Index having it worse, with way more stocks declining than the number of stocks which are advancing, 1% lower. But what's also heartening is that the Nifty is maintaining lows at important support zones as well. 24,150 was the zone from on July 5th, which is last Friday. We saw a bit of a recovery from these levels as well, and today's low was pretty much similar to what we saw on July 5th, 24,140. So telling you 24,150 is an important support to watch out for. The volatility index had been increasing over the last few trading sessions, up today as well, telling you that there were signs of some overheating in the market, and maybe we had to see a bit of decline, and that's exactly what's taken place. And this morning itself, there were a lot of put writers who were caught unawares. So yesterday, as the market continued to move higher, we saw heavy writing at the 24,300 put and also the 24,400 put. Now, this morning itself, with the market falling, these put writers were running for cover, and that accelerated the decline. Now, that has been arrested. On the way up, however, the 24,300 call writers are still active for a premium of 62 rupees, telling you that, while the support is around the 24,150 mark, on the way up, crossing 24,350 would be crucial to watch out for. In the morning as well, the put call ratio is at 1.28 was on the higher side. Now that's come down to a more believable 0.85. So that's something we'll keep an eye out on. And in the second half, what will be also interesting is how the Nifty Bank behaves, because on the way up, 52,500 call for the Nifty Bank, extremely active and has the maximum open interest almost across shares. And at the lower level, there is strong support at the 52,000 mark itself. The Nifty Bank currently in the middle of this range itself. In terms of stocks, we're watching out for a lot of long positions being added in Pidilite in an otherwise wobbly market. Once again, Pidilite has been picking up pace, and RBL Bank is one that I'll be tracking in particular from an FNO ban standpoint. Remember, we're in the second week of this July series, and we already have 9 stocks in FNO ban. Let's see whether RBL becomes another entrant.
Okay, all right, Mangalam. Thanks very much for that. So that's the FNO setup. Pritesh Mehta joins in now to discuss the technicals of the market. Now, Pritesh, well, it is definitely a market which has seen some amount of a recovery, but the texture is still very weak today. What would you recommend? One on the Nifty, which is down around 176 odd points. How would you approach specific stocks there, as well as the broader markets?
So now see, when I look at disparity between the average and the price, when I talk about Nifty, it is extremely high. I'm not comfortable at this level to be long in the index. I think market is supposed to go to a period of retracement, and there are a couple of hurdles in place when it comes to index. We have a couple of GAN numbers at play. We have Bank Nifty underperforming Nifty now, financial underperforming Nifty. We're talking about 2 large sectors underperforming Nifty. It is in the short term. So in this kind of scenario, we might see Nifty retracing back, coming lower. And we also have a budget announcement next 2 days. So till that time, I think staying light will be the right way to trade in this market.
Okay, can you give us specific stocks?
Yes, we mentioned how certain sectors are underperforming index now. So realty is one space that is underperforming. So when we deep down within the real estate basket, DLF is the one stock that has caught our attention. The stock has been facing resistance around 45-degree downslope trend line, and we can see further correction coming in. A move towards 760 is possible. The stop would be around 860 for going short. The second stock that we like, that we are bullish on, is Apollo Hospital. Now, this particular counter is outperforming our hospital diagnostic index. And when you look at the standalone chart, it has given a bullish ABC breakout. I'm expecting levels of 6,800, and the stop would be around 6,120.
All right, Pritesh, thanks a lot for joining in and giving us all those details on a lot of these individual stocks. A couple of them doing actually well in today's trading sessions. We have Ethos, which we just spoke about, KDDL. Ethos is moving well. It's moved to the high point of trade. Some traction seen in a couple of other names as well, which are moving around. So we have, say something like a Pidilite, which we just spoke about being at the high point of trade. And alongside that, we have a bunch of other Brigade Enterprise and Westlife Food as well, which have moved higher. Let's talk about some exclusive news now. Sources tell us that major life insurance companies have taken price hikes in their insurance portfolio. Yash Jain joins in with the details of the same. Yash.
Well, Mangalam, it was just yesterday when we spoke about how the first quarter of current financial year has been a strong one for life insurance companies. There's another important development which we're learning from our sources today, and this is on the positive side. What we've been given to understand is that major life insurance companies have taken a certain amount of price hike when it comes to the term insurance business or the term insurance portfolio for them. Largely, there are 4 large life insurance companies which have taken this price increase. These include HDFC Life Insurance, Max Life Insurance, Bajaj Allianz Life Insurance and Tata AIA Life Insurance. We are also given to understand that ICICI Prudential Life Insurance is another one which is expected to take a similar kind of price increase very soon. That is in the term insurance portfolio. Let's speak about individual companies. For HDFC Life, what we've been told by our sources is that the company has taken about 10% price increase in the term insurance portfolio, but that is for age groups only above the age of 60 years. As far as the entire term insurance business for HDFC Life is concerned, it forms about 5% of its total individual annualized premium equivalent, but the portion for citizens above the age of 60 years would be much, much smaller. For Max Life Insurance, the company's high term insurance premium pricing between 1 to 6%. Term insurance is a larger chunk of its individual APE, about 9%. So, of course, a larger impact there for Max Life Insurance. Bajaj Allianz Life Insurance, their price increase ranges between 1 to 6%, and the term insurance portfolio forms about 6% of the total individual APE. Finally, Tata AIA Life Insurance, what we've been given to understand from our sources is that the hike is between 3 to 10% across portfolio, and across portfolio as in across age groups. Finally, ICICI Prudential Life Insurance likely to take a similar price increase very, very soon, about 3 to 5%, and that essentially forms about 6% of the total individual APE. 4 key reasons for this increase in term insurance prices. First one is inflation adjustment for these life insurance companies. Second one is the increasing coverage of term insurance in tier 2 and tier 3 segments, where the risk profiling is higher and hence the price increase has to be taken. Third one, underlying cohort changes. And finally, fourth one, reinsurance pricing remaining more or less firm at the same point for a very long time.
Okay, all right, Yash, thanks very much for that. So that's the update coming in on the life insurance companies. We need to take a short break, but before... Welcome back. Well, the Q1 earnings season kicks off. To understand and analyze the key expectations from the banking sector, we have Abhishek Kothari joining in. Abhishek, over to you.
Banking sector's Q1 FY25 will be about the outlook that the management gives out with respect to how they see growth ahead in terms of deposit growth, because deposit growth is slowing down for the system as a whole. As on 14th of June 2024, as per RBI, the year-to-date deposits have actually declined by rupees 3.5 lakh crore, or about 1.65% decline. So hence, deposit growth is the biggest challenge for the banking sector as of now. Loan growth as on 14th of June 2024, as per RBI data, was at 19.2% on a year-on-year basis, which includes the SDFC Limited numbers which have been merged with SDFC Bank, and around 1.7% with respect to quarter-on-quarter loan growth that we have seen for the industry. So cost of funds will continue to impact the net interest margin for the lenders. Hence, expect the net interest margin to decline for majority of the lenders. Banks will continue to lose out on their low-cost deposits, that is current account, saving account deposits. Hence, CASA ratio is seen at the lowest for many banks in years, as much as the lowest that they are seeing in last 8 to 10 years. That is why, with decline in net interest margin and lower treasury gains, expect the operating profit growth to be on the slower side too. So barring seasonality, asset quality is not much of a worrisome factor for the lenders in Q1 FY24. However, FY25. However, watch out for the pain coming in from the microfinance or the rural segment for the lenders. So recovery from bad loans had been driving the earnings momentum for PSU banks largely. Now it may be on the muted side in Q1 FY25, and that can actually have an impact on the earnings of the banks as well. Having said that, the best of return ratios is clearly behind for the banks. Now key estimates coming in from Kotak Securities are, for SBI they expect NII growth of 8.6% YOY and about 1.5% sequentially, while they are expecting the profit of SBI to decline by 10.6% YOY and 27.1% sequentially. So for Bank of Baroda, Kotak Securities estimates NII to be up 5.3% YOY and a decline of 1.8% quarter-on-quarter. Net profits are expected to be up 0.7% YOY and a decline of more than 16% quarter-on-quarter. Now for SDFC Bank, I have taken only sequential numbers because of the merger of SDFC Limited with the bank. So they are expecting NII growth of 3% on a sequential basis, while net profit to decline by 2.7% quarter-on-quarter. For ICICI Bank, Kotak Securities estimates NII to increase by 5.2% YOY and about 0.4% sequentially, while the profits are expected to be up 8% on a YOY basis and a decline of 2.5% sequentially. For Axis Bank, Kotak Securities estimates NII growth of 8.9% YOY and a decline of 0.5% sequentially, while net profit is expected to be up 4.2% YOY and decline of more than 15% sequentially. Back to you.
All right, Abhishek, thanks a lot for that. So that's what one can expect from banks. But before we sleep into a short break, just keep an eye out on all these insurance names. Yash had said that, they've taken price hikes for some of their term products. So HDFC Life has actually moved to the high point of trade. SBI Life doing well as well at the high point of trade. Would be interesting to see how Max pans out, and ICICI Pro too, which has seen a bit of a spike. Take a short break, come back, tell you more on the markets and a lot of other stocks which are buzzing now. Welcome back. The India VIX has moved to the high point of trade now. So second half is going to be very, very interesting. And as that is happening, a lot of these FMCG names are seeing some buying as well. So Britannia should come up for you. Britannia has recovered a goodish 2% from the lows, has moved towards the higher end of today's trading range. And Asian Paints has been doing well already. This morning it was, one of the buy calls of some of the technical analysts as well. So those are a couple of stocks that we're keeping on our radar. But in this market, we had two listings. One of them was MCure. A very strong listing, over 30% premium to its issue price, was well bid as well. Ekta joins in to tell us more details about the company and the post-listing life. Ekta.
Well, yes, the signs of a good listing were already there because the subscription was strong. It was at around a total of 67.87 times, NII 48.3 times, QIB 195 times. And the company raised 582 crores from 48 anchor investors as well. Now, the IPO comprised of around 800 crores of an OFS and around, or rather a fresh issue, an OFS of around 1151 crores. Now, what they will be doing is they will be looking to reduce 600 crores of debt from the IPO proceeds, which is a positive. So the debt will come down to around 900 crores versus 1500 crores. They get 48% of their sales from India, 52% from the international markets, have around 13 manufacturing facilities. The margins were a bit of a sore point. It was at around 19% for FY24 versus 20% on a year-on-year basis and versus 23% in FY22. The last 18 to 24 months, the company has said, was impacted because there were around 1,000 medical reps which they hired, and that really impacted the margins. Now, if you look at the margins as compared to its peers, Aurobindo is a close second to is close enough to them. But if you compare them to Dr. Reddy's, Cipla, Sun, they've all done better when it comes to margins. FY24 trailing PE, again, MCure seems to be more expensive at this point in time. Closest peers at around 40 times. Now, the company says that there is a second wave of CapEx, which is around 1,200 crores. And there will be 4 facilities which will be getting commissioned, which will probably aid margins. Another key point to watch out for is that Sanofi and MCure tied up for cardiac drugs, partnership of distribution of cardiac drugs of Sanofi in India. So whether or not that will be a big kicker in terms of revenues for the domestic business is something that the street will see. Chronic drugs, important part of their business, around 45% of their sales. Chronic drugs are for, conditions which you constantly need the same drug. And they are quite bullish on that segment, and they expect margins to be positive there as well.
All right, so that's about MCure. What we'll do is we'll actually take a short break, and on the other side, we'll get you more details on the other listing that we have, Bansal Wire, a 35% up move on that one too.
Welcome back. Well, we did speak about MQ and the strong listing that it saw there. It was up around 35%, but we have Bansal Wires, which is listed strongly as well. Before we get to that, the UP government has called for stakeholder consultation on implications of EV and hybrid policy. Remember that Maruti was up on account of the tweaking in the registration fees for the hybrid, strong hybrid vehicles yesterday. And now the UP government is saying they've called M&M, Tata Motors, Maruti and the rest to discuss EV and hybrid policy with the companies tomorrow. So we'll get you more details on that. That's the latest which is coming in. Remember, Maruti was one of the top gainers on the Nifty yesterday on the back of this news, still holding up with a gain of around 0.8%. But let's talk about those big listings then. Bansal Wires has listed at a very strong premium as well, giving competition to MQ today. Its offer price was around 256 rupees per share. Nigel is here with the details.
Well, that's right. Bansal Wires had a blockbuster listing, in today's trading session. They were looking to raise close to around 745 crores odd, and the entire issue was a fresh issue. It wasn't an OFS, so all the money comes back to the company. The issue was subscribed close to around 60 times odd, which tells you that this issue saw a lot of demand. What were they raising this money for? Well, primarily to repay some of the outstanding debts as well as borrowing, and also ease the working capital requirements a little bit. Now, if you look at the annualized EPS for the last year, it was around 6 rupees odd. Now, since it's listed at a premium of close to around 35%, how do things shape up? Well, at this listing price of more than 35%, it trades at a PE of around 56 times odd. The nearest possible peer could be Raj Ratan Global Wires, and that one is currently trading at around 43 times its trailing earnings. Remember, Bansal Wires is far bigger. Though the margins are relatively lower at around 6% odd, it's trading at a bit of a premium. On the ROCE basis, both of them trade in mid-teens, 15 to around 18% on the ROCE basis. Not like to like, but as of now, it appears that Bansal Wires is a little bit more expensive in comparison to Raj Ratan Wires. Now, why is the street enthused? And why do they believe that earnings will improve from here on? Firstly, they've raised this money of around 745 crores odd. It will be used to, deleverage the balance sheet. And the management told us they'll almost be debt-free. Point number one. So interest costs will get saved. They're more than doubling their capacity. From around 2.5 lakh tons, they're going to around 6 lakh tons. So operating leverage will play out, and there is growth outlook as well. And point number three is they're changing their mix. They're getting into specialty steel. Out there, the tonnage could be around 20,000 tons as per what the management told us. And this will, call for higher margins as well. So profitability will look up from here on. So maybe on a forward basis, it's not so expensive. What are the risks? Well, they're not backward integrated. So raw material risk, obviously, that's a bit of a risk for them, both in availability as well as fluctuating. And also, since they're looking at upping their export exposure, currently it's in low teens. So any kind of change on the geographic dynamics, well, that's what could hurt them as well. All in all, a solid listing is what we're seeing, and the street is looking ahead that the earnings will improve. Back to you.
All right, Nigel, thanks a lot for that. That's about a solid listing. Meanwhile, while Nigel was speaking about Bansal Wire, there were flashes at the bottom of your screen speaking about maybe a review that the UP government would do. And this is with regards to the hybrid EV policy, the hybrid vehicle policy. What we understand from our sources is that the UP government has actually gone ahead and called for a stakeholder consultation on the implication of the state's electric vehicle and hybrid policy. The companies that have been called for this meeting include the likes of Mahindra Group, Hyundai, Tata Motors, Maruti Suzuki and Toyota India as well. So that'll be very, very interesting to watch out for, because this was one of the reasons why, there was such a big move in the entire auto space in yesterday's trading session. And we saw Maruti move almost 7-8%. Today, the stock opened higher, but from the highs, we've seen a bit of a decline. And currently, Maruti Suzuki is sitting with a gain of just about 1%, while the others are lower in today's trading session, again, for more reasons than just this. So a consultation on this would be extremely crucial to watch out for. So this is something that we'll track. On that note, what we'll do is take your leave on this edition of Halftime Report. Business Lunch will take all the market action ahead.